Hey, this is David Skarika. I hope everybody is well. So this is our stock chart of the day for the 21st of September. So we're gonna have something cool this weekend. This will be our last time, like the 3-for-1, I guess you could call them, is for free because we'll be launching our paid Patreon this week on my birthday, September, or next week on my birthday, September 27th. It's a nice little birthday present, I guess. Or maybe I'm making work for myself on my birthday. But anyhow, we're gonna have a cool thing. I'm gonna do 4 charts because remember the way I'm gonna do it is I'm still gonna have the free chart one on the weekends, and then I'm gonna have the 3-for-1 just for paying members. So, but what I'm gonna do this weekend is, I do my walks on the beach and show the charts on the websites. I'm going to I'm gonna do 4 charts from 2 oceans. So like one thing that's unique about where I live here in Eleuthera is we have Surfers Beach. That's the beach you usually see me walking on, which is kind of like thick, duney sand. Although I showed you a lot of the sand has been washed away, and the waves, and there's it's one of the Bahamas has that clear water because it's surrounded by reefs. So it's one of the few areas here in the Bahamas too. It's on the Atlantic. And there's no reefs. That's why you get, it's deeper water. You get the waves, et cetera, et cetera. And then just a 10-minute drive up the road from me, you can go to a place called Golden Key, but it's spelled Galding, like Gaulding. So there's a beach there that's Caribbean side, that beautiful water. It's a very light sand beach, that kind of thing. So anyhow, that's what we're gonna do. It's a lot of so it's gonna be like two. And it's what's cool about it is like, yeah, one is on the Caribbean side and one is on the Atlantic side, and they're a 10-minute drive to each other. So that's what we're gonna do. We're gonna do 4 charts from 2 different beaches. I'll have to come up with the ideas for the charts. That's the good thing about doing this. Like, this is going to be coming out Thursday. Friday will kind of give me time to brainstorm, and either Friday evening or Saturday I'll do those 2 charts, or I'll maybe go to one beach on Friday evening, one beach Saturday, and we'll blast these things out Sunday. So anyhow, I just wanted to tell you that. So I'm actually getting pretty excited. I'm launching another service too. It has to do with football. It's a little side venture, which I think actually can do well. I will blast this once. This website, of course, is about investing. But if some of you are interested in football or sports, you might want to subscribe to this site. It's not a pay thing. I mean, subscribe on YouTube or the whatnot. So, okay. So now today we're going to look at, we talked about the strategic oil reserve. So today we're going to talk about the total rigs. So rigs are the number of rigs, drilling for oil. So this is a 25-year chart, and it shows us like during the 2000s, when the fracking boom was kind of starting before the financial crisis. That's really when the fracking boom started here. And then you can see the financial crisis happened, oil prices fell, there was a credit crunch, and then the fracking boom continued. And basically you had over 1,500 wells drilling, rigs drilling, basically from 2011 to 2014, which is one of the reasons prices fell, because all of a sudden there was all this supply, and the U.S. became one of the largest producers in the world. It actually surpassed its oil production. Actually, we'll look at that too. U.S. oil production. Let's go look at that too. Yeah, you can see that like it rose to a record last year of 12.76. This year, right? So that's gonna but now you can see it's fallen for the 3rd straight month, and this is kind of what we're going to talk about now. One second. I have this. So anyhow, we'll just go ahead the images right here. Yeah, so you can see here, some of these charts go back here. So anyhow, you can see that during this fracking boom, this goes in 2019, but it basically tells the story that that the fracking boom kind of led to this huge surge, the highest since like the early 70s. Now, on a per capita basis, it was still well below that because, of course, the population is much higher. But what I'm trying to show you now is just like that rig count being high for years, basically being over 1,500 for most of about 2005, 2006 to 2014. Most of those 8 years, most of those 8 years, at being that high, you can see, that led to that huge increase in production we've seen. And then it collapsed when oil prices fell. And then it kind of went back to 1,000 pre, COVID, collapsed again when oil prices went negative. And you see that we've gone nowhere near here. And again, a lot of this loaning that, money that was loaned that went towards the fracking boom came from like smaller regional banks, in the Midwest, in Oklahoma, in Texas, etc. So basically, that's kind of gone now with these things having a labor crunch, and then all these policies of ESG and green all played a part. So I just think now we're set up. Now we've seen, just like we saw nearly 10 years of a lot of exploration and drilling, which led to that higher, production. Now we've seen basically almost 10 years of lower exploration and drilling. So we found all this oil here, and then we produced it. And I think at some point, like we just showed you, the production has been done down now for 3 straight months. And the thing that's interesting is, like we look at the production, it's like, or them selling the strategic reserve, and oil prices kind of, been staying in those 70s to 80s for the most part. Again, that reduces the incentive for these people to drill. Where if they hadn't done the reserve, sale, I think we'd have oil, and you don't know what shenanigans are going on. We all know that us in the precious metal sector, that the Federal Reserve, there's a lot of, or banks, there's always these rumors and I guess you can call them conspiracy theories, that central banks come in and sell the futures market to keep gold down. So who knows if they're doing that in oil? Oil is a little more difficult because oil is something that you use more day to day, So you put your gas in your car and you burn it that day, right? So that's the issue with oil and gas, right? So it's tougher to manipulate longer term, but it definitely, if oil was 100, 110, I would expect, even with, policies turning away from fossil fuels, I would think that this rig count would probably be, back to like that 2018, 2019 period as well. And remember, this was probably not going to happen again anyhow, back, because that was the fracking boom, and the kind of the easy wells that could be fracked were, okay. So what's interesting in Canada, it's kind of a different story, where actually it's kind of at the historical average right now. You can see, again, there was this kind of big boom in Canada back in 2014, 2015, where over 400 wells, rigs were enacted. And remember, Canada is 1/10 the size of the U.S. in population. So we showed you the U.S. was like, whatever, 2,000 at the top. Well, that's like the U.S. being at 4,000, So right now, Canada, you can see, is about 200. For the most part, taking out that, Canada goes between about 200 to 300 on the upside, and then when things are bad, like 20 or 30, or yeah, mostly that is extreme, that 20 or 30, man, like 70. So we're kind of in that middle of the range now. We're in the higher end of the range, but Canada has definitely not kind of seen that. And I think probably one reason is credit. Canadians do things differently when it comes to mining, and drilling. I know because I've been in junior mining for so long. Americans use debt, and there's a credit crunch going on right now at the regional banks, and Canadian companies mostly use equity, like private placements, etc. And even though that equity can be dilutive, you can always, I find that these companies, if they really want to, they can always raise a little bit of money, 500 grand, $1 million, to do what they want to do, even in bad markets. Now, sometimes the company is going to get a little shafted on the terms because they have to be lenient on the terms, give a very generous warrant, generous discount to the current price, but usually they can get it done. Anyhow, so I wanted to show you that. But the basic thing is, we're really looking at the US. And if we go to the totally max, you can see back in the 70s oil boom, you can see this was a real bubble here. You had over 4,000 rigs in drilling. And then during the 80s, and again, look what led to the higher prices. It's not just printing money. It's supply demand. Basically, from the late 80s to the early 2000s, there was no rigs, for basically 15 years. And then that led to like a near record low of oil production in the United States. And which we'll again look at here. Yeah, that led, not record low, but like multi-decade low, right? And again, the population in 2010 was a lot higher than 1950. So that led to nearly a 60-year low in production. And then of course now I think that's what we're going to see now, this lack of drilling. And you can see it takes a while. It took like basically, that 15 years of like lack of drilling didn't really lead to record low production till 10 years later, right? When it went, and then all this drilling that happened from the mid 2000s to, basically 2019 didn't lead to record production until, or actually, sorry, 2014 didn't lead to record production till like the last few years. So these things take a while. It takes, some of the larger finds take a while to get in production and that supply, et cetera, et cetera. So I just think that, we're going to see probably in the next 5 to 10 years that take hold and oil prices move much higher because of that. And it'll take a big policy shift, and the era of cheap money is over. So even with the policy shift being more pro oil and gas, pro energy, well, guess what? The issue is, are these banks going to lend out, right? One reason they got that 15-year malaise in drilling was that the banks in the Midwest went under when oil went, to single digits in 1986. So they didn't want to loan any money for drilling oil after all these banks went under and credit was tight for that industry. So I think, it's kind of like that now, that the era of super cheap rates are over. So these banks aren't going to really want to lend for that sort of thing for probably years. So if we go back here, this is the oil price. I've talked about this recently, that this breakout that's happened now. We are short-term, very overbought. You can see the RSI went over 70. If there is some kind of correction in the markets that we've been talking about in September, October here, oil prices could be taken down. We've gone basically straight up from just under 80 to just over 90. So maybe we see a correction here back to the 50-day moving average before moving higher. So I don't really want to take a bullish stance on oil here. Short term, a super bullish stance. So let's just wait and see what happens. And also, this is the time of year that sorry, I just had something in my throat. Welcome to the not so perfect world of podcasting. And also, this is the kind of time of year that with demand is weak. Where the summer driving season's over. We're in fall, so we're in between. A lot of the areas of the country don't need heating oil because it's not cold enough yet. They don't need air conditioning because it's cooled off. So it's kind of always, this is kind of the malaise in September, October, and usually November, December is when the winter heating oil demand kind of picks up. So short term, yeah, but we can see the longer term with the rigs, kind of collapsing and actually being where they are usually during lows in the economic cycle right now. You can see we're back to the lows of those 80s. So if this kind of continues for a few years, is a very long-term orientated chart. We're going to see oil production decrease. Maybe we're in the early stages of that, even though it's going to be near a record this year overall. And if that starts decreasing, if the U.S. starts, say, producing, 10 million barrels a day instead of 12, that may not sound like a lot, but I think the global oil market's about 100 million barrels a day, but that 2 million barrels can really set off supply demand, and prices have to go up 20-30% just to bring down the demand. So, so there isn't a deficit in supply, right? So that's the way the oil market works. It's just a couple percent in the terms of the production can lead to 10x that in terms of the price move of the underlying commodity. Okay, so this is that was Stock Chart of the Day for today. Like I said, there will not be one on Friday. Friday and Saturday I'll be doing some videos to blast out on Sunday, and then again we'll talk a little bit more about the pay service, et cetera, going forward. And I hope you enjoyed this. I think we look at things like, I don't see a lot of people talking about these type of things in the financial media, et cetera, right? Because like all you see in the financial media is, like I said, oh, record production this year, but they don't look going forward, right? They don't look long-term orientated. They just kind of report on what's happening at the time. So everybody take care. And I'm going to put this up on the website.